Hi, good people. The first, let me introduce myself. My name is Pratama. Now I would like to present about the accounting cycle process. The first, you should know about what's accounting cycle. The accounting cycle refers to the complete process of accounting procedure followed in recording, classifying, and summarizing the business transaction. The accounting cycle starts right from the identification of this transaction and ends with the preparation of financial statement and closing books. The second, the second, you should know about how does accounting cycle works. The process of accounting cycle consists of several steps that help record and analyze your financial data. The key steps in the 8-step accounting cycle include recording journal entries, posting to the journal ledger, calculating trial balance, making adjusting entries, and creating financial statement. And the third, there are steps in accounting cycle process. Whether you are a business owner or aspiring accountant, it is important to know and understand the process involved in the accounting cycle. The accounting cycle consists of 8 steps listed below. First, identification of transaction. The first step of the accounting cycle begins with the identification of financial transactions that have occurred in the business. In this accounting cycle, the accountant or bookkeeper collect the data of all data transactions such as purchase, sales, payments, receipt, etc. and keeps the data ready to complete the next step of the accounting cycle. Here, the accountants or bookkeeper analyze the nature of transaction, accounts, impact, etc. The second, recording. The next step of the accounting cycle is the most crucial and important. In this accounting cycle, the bookkeeper or accountant record in the financial transaction in the book of accounts. This step of accounting cycle is also known as a journal entry, and the book in which is recorded is a journal book. Here, all the transactions are recorded in chronologized order along with the ledger accounts info, amount in debit or credit, and narration. The third, ledger posting. Ledger posting simply refers to posting the financial transaction recorded in journal book to individual ledger statements. For example, in preparing a cash ledger accounts, you must post all the debits or receipts and credit or payments into statement, and the difference between these two, including the opening balance of cash, will be the closing balance. This part of the accounting cycle includes posting all the debit and credit transaction into a statement belonging to a ledger account. The next, fourth, unadjusted trial balance. In this step, you must list all the ledger accounts with closing balance posted from individual ledger account statement. The format of the trial balance consists of the debit columns and credit column in which the closing balance of each ledger accounts will be posted. After posting the closing balance of all the ledger accounts, the debit balance should match with the credit balance. This is the primary source for preparing the final accounts and all others financial statement. And the fifth, adjustment entries. Here, adjustment entries such as accrued incomes, depreciations, etc., are posted in considering the unjust adjusted trial balance prepared earlier. And the sixth, adjusted trial balance. Adjusted trial balance is a statement listing all the closing balance of the ledger accounts after all the adjustments entries related to the accounting period is posted into the books of accounts. Seventh, preparing in financial statements. This is the most important steps of the accounting cycle. Once you have followed all the steps before of the accounting cycles, it's time for you to start preparing financial statements and profit and loss accounts and balance sheet are the two key financial statements. In the profit and loss account, maybe this is prepared to now the profitability of the business. This is also known as income statement. The next balance sheets. This is one of the topmost financial statements prepared by businesses. The financial detail of the balance sheets help you and the external stakeholder to evaluate the financial performance of the business on a given day. And the last eight, closing of books. Closing books of accounts refer to freezing books from recording the business transaction. This is done after the closure of the accounting period and posting all the adjustment entries at this stage of the accounting cycle. All the financial statements are prepared and new books for the subsequent financial year will be started. So that is all about my presentation. I hope you can understand the topic. Thanks for your attention and goodbye.